Hello and welcome to this monetary policy special. The minutes of the last meeting, that is of December 8, are out. The message from the governor is that, yes, inflation is moderating, but, and I'm quoting him here, the projected inflation in Q3 of next year, that is 1 year from now, is 4.7%, which is perilously close to 5%, end of quote. He also warns that conditions ahead could be fickle. The external members sound slightly less worried about inflation, but let me have them speak for themselves. Joining me now are the external members of the Reserve Bank's Monetary Policy Committee, Dr. Ashima Goyal, Dr. Jayanth Varma, and Dr. Shashanka Bhide. Gentlemen and Ashima, thank you very much for sparing time for me this evening. Ashima, let me come to you first. You are sounding like the circumstances are more propitious for a rate cut. But the governor, even 1 year ahead, seems like 4.7 is not good enough. It's perilously close to 5. Do you see yourself at odds with this view? Do you think that as we get to 4% in second quarter of next year, according to projection, the MPC needs to soften its stance?
I think we need to wait a few months and see that it really does soften and sustain below 4, because unfortunately we've had a number of periods when it's been approaching 4, but then some supply side shock and it spikes up. So, but this time what is different is that core inflation seems to be softening sustainably. And we are seeing that the supply shocks are becoming shorter, they are real spikes, they don't last long. So I think we wait a few more months, and we see, because the RBI also expects inflation to fall in the mid-year and then rise again. But that rise again might not happen. And as we approach closer to the period, we'll get to see that. Okay. So, but even if it is about 4.7, we also have to be careful that the real rate does not rise too much, because with 6.5, even if inflation is 4.5, the real rate is 2%. You don't need that to decrease inflation sustainably towards the target.
Okay. Well, I will ask Jayanth Varma that, because he has specifically said that, 2% is too much of a killer of growth. But before I come to Dr. Varma, Dr. Bhide, what is your, what would you look forward to ensure that you can at least change the stance? What will those signs be? And what should the stance change to, of course?
I think the projected inflation rates should be consistently close to 4%. Okay. So I think, that to me is important. As Ashima said, and you have said, the current trajectory is one where the inflation rate is moderating, but I think it is still well above the target. And I think there are these concerns, at least in the short term, that we are vulnerable to supply side shocks, especially, I think, in the case of food. So I think that is the concern. But I think that what will change the stance is consistently projections of inflation rates, closer to 4.5% or less.
Okay, Dr. Bhide and Dr. Ashima, the statements from Michael Patra are a little more hawkish, or at least cautious this time around. I don't know if you have a chance to read his minutes. One, he points out that consumer inflation expectations have actually hardened a bit. He says that although they do expect the inflation number to remain flat in a 3-month period, they are less sure than they were in the previous consumer survey of the Reserve Bank. And 1 year ahead, they are far less sure that inflation will dip. That is one thing he points out, that consumer sentiment over inflation has not been as positive as it was in the previous survey. And the second thing he points out is that output gap has turned positive and on the margin. And therefore, there stand a chance of demand-led inflation. Ashima, your thoughts on these?
Yes, the change in consumer expectations is very marginal. And again, we need to see if that sustains and strengthens. So we watch it for some more months. And for potential output, I have argued that we need a forward-looking measure while all these time series estimates on which it is, they give too much weight to past growth. And if we are going through a structural change where India's growth rate is sustainably and potential output could be actually rising, because we all know that we have high underemployment, we are in a transition towards a more developed economy. So we can't rely on the past in order to infer the future. So there is a literature which suggests that you judge potential output by inflation.
Okay.
If there are enough reforms and supply side changes to keep inflation within the tolerance bands, then we cannot assume that potential output is reached. And the softening in core inflation suggests that, because core is affected by potential output. If we had exceeded our potential output, we should see core strengthening, but we are not seeing that.
There are arguments out in the market against these as well. There are people who point out that core is softening because globally supply lines have come back. And at some point in time, that will flatten that curve. You can't see the supply line positivity to go on continuously. What was shut is coming back. And therefore, we are having a positive core. It's the experience across Asia. And secondly, 7% is a fairly aggressive growth, is a fairly good growth. Dr. Bhide, does this growth even need more crutches? Is there a case even for cuts now?
Obviously, I think we have had very good growth in the first 2 quarters of the year. I think I also, I guess it's positive that the growth has also happened when the core inflation particularly has softened. So I think there is obviously a sort of pressure, not so much from the demand side, but I think I would still think that the growth being somewhat uneven, there will be price pressures in specific sectors which might affect the non-farm sectors prices also. Okay. So I think it's a good growth situation, and therefore I think we should be happy that the core inflation has kept low.
Okay, Dr. Varma, thank you very much, sir, for rushing back from your class. Deeply grateful to you for that. Let me come to the point you are making, that at the moment, nearly 200 basis points real rate is not very positive for growth. It's inimical for growth, and that we should move towards 1.5. Now, if you take the forward forecast of the Reserve Bank, it's 4% in the second quarter and 4.7% in the third quarter. That is 1 year down. By your estimate, we are already due for a cut. Are you therefore disappointed? Would you want a cut sooner then?
No, I mentioned in my statement,
yes,
that after 3 years of excessive inflation, I am willing to understand some degree of caution. We've had a lot of volatility in variety of things, commodity prices, food inflation, and so on. So I'm willing to accept some degree of caution before plunging ahead and cutting right away. One might want to look a month ahead or 2 months ahead and see that the trajectory that we are projecting is being realized. So, and then wait to cut then. But clearly, I think we are really at the borderline of a cut.
Oh, okay. That's important, sir. That's a very important statement you're giving us. You also point out that the prevailing money market rates of 6.75% are really close to the MSF rate. Now, this is a matter of, is this something that you take up seriously with the Reserve Bank in the MPC? That they have not kept it at 6.5 for a goodish bit of time. Does that rankle, Dr. Varma?
Yeah, so, repo at 6.5 would mean a real rate of 1.75%. It is, it is the money market rates being pushed up to MSF that is pushing the real rate to 2.
Yes.
So you could get 25 basis points by simply bringing the money market rates to the middle of the corridor.
Yes.
So that is another reason why, one can do that without actually moving the repo rate. You can bring it closer to 1.5 by just letting that happen. And I'm very clearly in favor of that. Okay. That bringing the rates closer to 1.5 is what is called for.
Okay.
But at the end of the day, liquidity management is the central bank's problem. It is not the MPC's problem.
Of course.
I used to have this debate at that time as well when we were at the low end, and I was pushing for bringing it to the center of the corridor.
Yes.
That ultimately, if the rate is going to be, if the money market rates are going to be kept at one end of the corridor, then you will have to move the whole corridor down. That is the only other option. That you move the repo rate itself down.
Yes.
So that even the upper end of the corridor is
moving towards 6.5.
acceptable real rates. That is what would happen ultimately.
Fair point. Of course, liquidity is expected to improve, as Ashima Goyal points out in her minutes, as the government spends more in the fourth quarter. At the moment, that's keeping the durable liquidity strong, but interbank liquidity very weak because the government, a lot of money is stuck with the government. But Ashima Goyal, what about the argument that Patra is making that output gap is positive? And there are other economists who are also making the point that actually this is a fiscal deficit of 9%, which is gendering a 7% growth. So, there are enough triggers that can push up inflation. Is that a matter of caution that the MPC has to watch out for? The fact that output gap is closing and that this is still a fairly loose fisc.
Right, I agree with the caution, and that is why we have said pause and watch for some more time. But I think that ultimately for core inflation to rise, you need to see signs of second round labor market tightening. We don't see that at all in India. In the IT sector, this was happening, but the export slowdown for IT has meant that wage growth in the IT sector also has softened. So where are the sectoral bottlenecks? Another thing we are seeing is that manufacturing has grown, output has grown much more than expected. And at the same time, capacity utilization has remained constant. So I think the much waited for private investment is really happening. This time we saw a lot of indicators, such as a rise in physical assets with firms, etc., apart from the normal steel and cement. So if firms are investing, then, and the government is doing supply side reforms, these are the factors that raise inflation more than excess demand in India. Because we have a large underemployed labor force, and as long as capacity is expanding, and costs are decreasing, we can increase employment and grow. Many people say that we need to grow at 8% for full employment.
Yes.
So our potential output, full employment, our potential output is 8%. We are much below that.
It's a contentious debate out there on employment. We've had higher unemployment, at 7-8% for a long time now. And it has prevailed along with high inflation for a very long period. So that justification that signifies that inflation won't rise is not always worked out in the past. And again, unemployment numbers itself are more a matter of faith and which series you look at, really, private or public. But many more questions coming your way, sir. I have to take a quick commercial break. Back in a jiffy.